Welcome back to EDS, and in this video I'm going to show you how to grow your small account as fast as possible whilst also being as consistent as possible. So what you want to do is open up your brokerage platform and you want to open up a watch list of futures with options contracts available to trade on them. If your broker doesn't display that information, just take note of these ticker symbols and make your own custom watch list. Now we are going to be writing options contracts on futures contracts. This allows us to have a high probability of success and also a high return on capital. When we write options contracts, we can craft and engineer our probabilities of success on entry, and by using futures, which uses span margin, that allows us to be capital efficient, and that's what's going to give us a high return on capital while still maintaining consistency. So once you've got the watch list open, you want to only really pay attention to things with an IV rank of 30 or more. Anything over 30 is considered high, anything over 50 is considered very high. And the reason why we do this is because option prices increase when volatility increases, and because we're going to be writing the contracts, that basically means we're short the contracts, and whenever we're short we want to sell high, buy low. So we want to sell when volatility is high and play the contraction back down to the mean and further below. Volatility is mean reverting, and that's one of the reasons why this works so well. So once you've got that in mind, once you've got your watch list set up like this, you want to pick an underlying that would fit well in your portfolio. I'm just going to assume that you don't have anything in your portfolio right now, so you can choose whatever you like. Now, futures are very big products, and the contract multipliers are big, and your buying power requirements will vary depending on which underlying you go for. A lot of factors come into play, especially absolute IV, your absolute IV level. So the lower the IV, the less buying power is going to be required, typically speaking. However, there are some exceptions to this. Generally speaking, currencies, they don't really move too much, so they have low IVs most of the time, and that's going to allow you to get into positions without using much buying power. So once you've got that in mind, we're just going to use the Canadian dollar futures. I've used the Canadian dollar futures before to grow small accounts. It really doesn't require too much buying power, and as you can see right now, it has a nice IV rank of 66.8, an absolute IV level of 8.6%. So we're going to go over to the trade tab, and we can now see a list of expiration dates for the options contracts on the left, and then we've also got the corresponding futures contracts next to it. So for example, February 7th, March 7th lines up with the H5 contract, April 4th, May 9th, June 6th line up with the M5 contracts, and then we've got U5 contracts further below. You don't really need to worry too much about this. All good brokers should display the information like this or in a similar format. And what we want to focus on are the option expiration dates. And the one that we want to pick needs to be between 30 and 60 days out in time. So there's one here with 38 days left on it at March 7th. So we're going to open that up. And now we are presented with the options chain for the March 7th expiration date. And very quickly to explain what's going on, we've got calls on the left, puts on the right. We've got this horizontal orange bar that shows us where the price of the underlying is with respect to the strikes that go down the middle. We have our expected move bar here, shown by this orange vertical bar ruler thing, and we have our dotted blue lines which show us our standard deviation levels. You can just put data into a spreadsheet over the past year. You can just use Yahoo Finance or something if you don't have standard deviations marked by your broker. However, we're going to be using 3 points of confluence, so if you don't have any of these things, just make sure that you have delta, and you'll be able to work off of delta. If you still want to know your standard deviation levels, you can just get the past 365 days worth of data from Yahoo Finance, put it in a spreadsheet and calculate your standard deviations from there. If you don't have your expected move visually displayed like this, then it should be displayed next to your volatility level for that specific contract. Most brokers will show you the expected move. So once you've got everything set up like this, what we want to do now is sell one call and one put. Okay, and when we sell a contract, we basically want price to stay away from that contract. So in order to get a high probability of success, we want to sell contracts outside of this expected move. The further out we go, the higher our probability of success, but the lower our return on capital will be, because we collect less premium on entry and we're taking less risk. Therefore, our return will be lower. So a nice medium point for me is to be around the 1 standard deviation level, and all three things will typically line up with the 15 to 20 delta range. So we've got our 19 delta strike here at the 0.71. We're going to sell that contract, and then we have a 20 delta on the put side that lines up with the 0.68 strike. And what we've done is we've created a range for ourselves. So we want price to be within this range at the point of expiration, which is in 38 days time. And what you'll notice is these contracts sit around the 1 standard deviation level. They're in between 15 and 20 deltas, and they're also outside of the expected move. And all of these things are going to give us a high probability of success. As we can see in the bottom left corner, we have our POP, which is probability of profit, and that's our probability of making at least 1 penny on this trade, and that's currently at 66%. Anything over 50% is considered a high probability trade, so 66% is very, very good odds for us. Now, what if we don't want to wait all the way till expiration? What if we want to get out at, say, 50% of max profit? Well, we have our P50 number here, and P50 isn't displayed for futures. However, it is typically 10 to 15% higher than your POP. So our P50 is going to be in and around the 85% range. So we're looking at probabilities of success of between about 70 and 80%, give or take. Now, that's not taking into account any adjustments that you may make whilst the position is on. That will increase your probability of success. Also, implied volatility is generally overstated compared to actual volatility, so your numbers are going to be even higher anyway. But if we just work off of these numbers, between 70 and 80% chance of success, these are very, very high numbers to start with. So how much money can we make on this position? Well, right now, we can collect $380 of premium up front, and our broker is going to require 2.1k in buying power to open this position. Now, this is considerably more than what it typically has been. So what I'm going to do is go back to a different underlying and see if we can get a lower buying power requirement. We're going to have the exact same setup, March 7th. We'll go to the 15 delta this time, on the, because the 22, there is no 20 delta, it's just a 22 delta, which is a little bit high, and 10 delta is a little bit low. And we've got the 17 delta on the put side, exact same thing, same setup. And as you can see, in this case, we have a slightly higher probability of profit of 73%. So our P50 would be around 85 to 90%. Our max profit, which is the premium that we would collect, is $350, and our buying power requirement is just over $700. So as you can see here, we're getting a very nice return on capital, and we would get $13 of daily theta decay, as we can see here, and this number will increase and get more aggressive exponentially as we get closer to expiration, assuming all things stay equal. Now, if you want to get a higher return, you can be a little bit more aggressive and go to the next strike up at the 22 delta. And we can do the same thing and go to the 23 delta on the put side. And what we've done now is slightly lowered our probability of success to 66% pop, and our P50 will be around 80-85%. But we're now going to collect $530 up front, and our buying power requirement is just over $800. So we've increased our return on capital. Now, this is how you can craft and engineer your position and manipulate the position to fit your requirements. If you wanted a higher return, if you wanted a higher probability of success, you can even go way further out. You can go to, say, the 10 delta on either side. You know, we've got a 9 delta there and a 10 delta on the call side. Our pop is now 82%. Our P50 is going to be in and around 95%. Our return on capital is significantly reduced. Our max profit is now 180, and our buying power requirement is just under $650. However, we get a much higher return on capital. So it's completely up to you how you want to structure your trade, but this is how you do it. And you do need to keep in mind how much buying power you are allocating to your positions. And in order to figure that out, we've created a free position sizing template that's available for everyone to use. The link is in the description. Just click the button and it will take you over to this spreadsheet. The way it works is you enter in the size of your portfolio. So say if you have a $50,000 account, you then enter the VIX level below it. Say if it's 12.4. Everything will then be automatically calculated for you. You just need to use this as a guideline for your portfolio. It will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies, the minimum amount of your portfolio to allocate to undefined risk trades. What we went over today is an example of an undefined risk trade. And as long as you're following this, over the long run, you'll be absolutely fine. If you would like to learn in more detail about what we do and how we do it, the link will be in the description. Click on EDS Premium and get yourself signed up. Inside, you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. It is a private community, so if you get stuck at any point, you can speak with myself directly or with other like-minded individuals. And there's a 100% money back guarantee. So once you've been through our course, follow some of our trades. If after 6 months you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. We work the pricing based on waves. So our first initial wave was priced at £1 per month. This is now our second wave at $9.99 a month, and the third wave the price will go up even further. So the earlier you get in, the better it is for you. You are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to teach you the skill. And once you do know that skill, it's something that you can take with you for the rest of your life. Nobody can ever take it away from you. And we aim to get you to that point where you are completely self-sufficient within 6 to 12 months. You are always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.